Welcome back, dividend growth and value investors. In today's video, I will discuss two much requested quick stock analysis by some of you from the community. And oh boy, as you can see, the first one has a really nice dividend growth track record. Can you figure out already which stock this is based on this beautiful chart porn? Haha, if you do, that's really awesome. But before we start, a really quick update. This week I bought some additional Viatris, as I mentioned in 2 videos ago, at $10.88 and some HP Inc. at $28.94. I really feel that these two stocks are undervalued right now, so I'm more than happy to have added some to my portfolio. It also brought for both these stocks the averages down, so I'm actually really happy with this, and they are both yielding around 3.5% and 4%. So nice additional cash flow coming into my projected annual dividend income. And if you're interested to have an update on them, then please let me know in the comment section below. But hey, let's get back to the topic of our video. The first stock that you requested to me and that I will talk about today with this wonderful porn chart is Home Depot. Home Depot is at the moment already the world's largest home improvement retailer. I mean, it became the largest, I believe, back in 2007 or 2008 when it beat Lowe's. Honestly, I'm from Europe. I'm not from the United States. I've never been in a Home Depot, so I have to really had to do some additional research via YouTube, via the website to get a good feeling on it. But honestly, I love a lot what I'm seeing. Currently, it has already 2,300 retail stores, all located in North America, which includes the US, Canada, and Mexico, of course, the most in the US. A revenue of $150 billion. This is really a lot. So Home Depot, I guess most dividend growth investors in our community has heard of them before. Look, the stock price, if we look at it, it's currently trading at $330 at a 2.3% yield. That is generally below my 2.75 entry yield. On the other hand, if you look at it, the company was peaking at $415. In this year, it touched already $270. And who knows if this can still go below, but it's trading today, as you can see, at $327. So if we look at it, I really like this strategy. They want to grow currently their sales to $200 billion. That would be a 33% increase from what it is making today. But if you think about it, this company, actually why I think they have a winning formula is because they were one of the first home improvement stores that had a really good total customer experience, combining the digital world with the physical world. And actually in the last 2-3 years, it has even more attention to the pros. They want to be in a position that they can much quicker, deliver their goods in bulk, so that really the professional builders have also access and really strong access to whatever Home Depot has to offer. So I think this is really good that they're not only paying their attention to the consumers, but also really to the pros. What's more to like here, they think that the Home Depot's total addressable market is $900 billion. Remember, they're currently at $150 billion in sales. Half of this will be by the professionals and the other half by consumers, and their current share in the market is 17%, which they aim to increase. So how have they been operating then? Quite recently, comparable sales growth is really important with retail chains, and 4.3% in revenues is a really good sales increase. And also diluted EPS of 4.24. If they would do this, let's say every quarter, we're talking about a 16 EPS on the $327. That's probably something like an PE of 21. So what's not to like here, right? This company is really rocking. But what is good to know, if we look in the latest quarterly earnings report, they have added, I believe, 1 new store in the US. So this is not like Starbucks, where they're opening like 10, 50, 100 new stores all over the world, and even in China, even more, like 1,000 or something like that. Because also only 2 new stores in Mexico, and they had no store closures. So it is not something you scale really quickly. You really need to do your due diligence, do a market research, be in the place where also a lot of building activity is happening in those towns and villages all over North America. But what I also would like to call out from the last quarterly report is everything about inventory, because we have heard about supply chain issues all over the world with companies, and also Home Depot has been impacted by that. And what they are mentioning here is that their inventory turnover was 4.3 times at the end of the third quarter, compared to the 5.4 times at the end of the third quarter in fiscal 2021. This is not good for a company because the cycle time of their inventory is really important, and actually the cash generating activity that is important to them directly impacting their cash flow and their earnings. And what they are saying here is that the decrease in their inventory turnover ratio was driven by an increase in average inventory levels during the first 9 months of fiscal 2022, resulting from strategic investments to promote higher in-stock levels and pull forward merchandise response. And here it comes to the ongoing global supply chain disruption. So here we have it, also impacted by supply chain. That's why they brought a lot forward. And this is also something that we can observe in the cash flow numbers. And here you can see it, for instance, changes in merchandise inventories, again, 3.7 billion acquired inventory, let's say, cash outgoing, which they had to do. Last year, this was also already the case. But the difference here is they were not paying their vendors yet. That's why they had a favorable 2 billion in their cash flow. And now they had to pay, of course, all those outstanding bills. And that meant 1.5 billion left. So over the years, if you average it out, it's probably like a 12 billion cash provided by operating activities. Minus, if you look at that, their capex, we're talking about a 10 billion in the last 9 months in free cash flow over the last 2 years on average, right? So this is important to realize that they're impacted by inventories, because also this matters when we do our discounted cash flow analysis. But let's have a look at Home Depot. I believe that their dividend is safe. It should come as no wonder if we go back to their actually outstanding dividend growth track record. The only little blip here that I would say is that after the 2007 and 2008 great financial recession, they have not been growing the dividend, but this should also come as no surprise. This was probably the most severe housing crash that they have seen in North America and the United States. So for me, kudos actually to management that they were able to maintain their dividend. But this is also when, if you go to the dividend aristocrat list, that you only see 13 years of dividend increases. But otherwise, if you think about not cutting their dividend, we're talking about 34 years. For me, this is really, really awesome. Now, what's more to like? Strong free cash flow growth over the last 5 years, 10%, 25% earnings growth, strong credit rating, A2, nothing to say about. Interest coverage of 15. They can easily pay their interest. The only thing you could say is debt to equity, but this is a result of having no equity, actually negative equity, because of all the share buybacks that they have been doing. We've seen this also in Starbucks in the past. Payout ratio 76% due to inventory levels, but if we go to the EPS, 46%. So really strong in my opinion. 5-year dividend growth of 22%. I mean, this is amazing. Honestly, although I think their growth prospects are strong, what we have seen with the sales growth during COVID, where many people had some extra cash, started to renovate their houses. What else do you do if you can't meet any people? So I don't believe that this 22% will be, common in the next 5 years going forward. And here we see it again. Their EPS is nicely growing. Their free cash flow impacted. Also here, if we look at the cash allocation, since 2014, they have been actively repurchasing a lot of shares. You can see it. If it's all above the line, it means that they are rewarding shareholders more than what they are getting in free cash flow. And we can see that here again in the balance sheet trend, where the long-term debt has been growing and their equity has been lowering. Unfortunately, this is what you get with a zero interest environment. That's also why I think that the share repurchases out of free cash flow will not be so strong anymore as we have seen in the last decade. On the other hand, they have been able to almost halve their outstanding shares. If we compare from 2003, 2,300 million shares, now 1,000. So 60% decline in share count. I mean, they have really done this. And this, you can also imagine, has really contributed to the EPS growth and free cash flow per share growth. Now, let's look then at what I think this company is currently worth. If we look at it, what currently price earnings multiple of 19 or 20, which is actually really nice, I would say, and going forward as well. But what really shows the strength of this company is that they have a really high return on invested capital, way above the weighted average cost of capital, 25%. I don't see this a lot. Having said that, if we then go to the fair value based on the discounted cash flow analysis, I truly believe that the future sum of cash flows discounted to today is what the company is worth to pay for. I'm taking a 14 billion in free cash flow. If you heard me earlier saying over the last, I said 2 years, in the first 9 months, they were having around 10 billion in free cash flow. Make it 12. If I look more like what 2022 was doing and more like the average of these three, I believe that 14 billion is reasonable to think about, specifically if they get their inventory under control. Therefore, though, I'm not using the same growth numbers that they have been experiencing over the last 5 years. I'm using 7% growth in the first 5 years, 4% thereafter. Unfortunately, in this environment with high inflation, I'm expecting more return for my holdings. So therefore 12.5%. But because it's a high quality company, I'm not asking 14 or 15 of a terminal multiple but 16 instead. In that case, I believe that the company currently has a fair value of $200. If we are a bit more optimistic, 10% and 5% thereafter, we're talking about $250. However, if it's bearish and we will see, for instance, a recession coming up and therefore it will be hard for consumers to spend more, I still believe the company will be able to grow. It will be then rather 5% and 2%, and then this company should be half of what it's worth today, $167. So for me, guys, you asked for it. This is my analysis about Home Depot, quick analysis. I think it's currently heavily overvalued. The stock price, I believe, earlier this year was one time around 270. So we haven't even seen it close to where I think the value should be. On the other end, if you are thinking more from a dividend growth point of view, I think the dividend is safe. If you are also thinking, therefore, by just having this stock in your portfolio, I could say around 270. It's could be interesting for you to buy it then, at least the initiating position, because then your yield will be somewhere around 2.75%, and then the compounding makes sense if this is an above average dividend grower. Really quickly, guys, I often get the question how you can support me. Well, really simple. I love coffee. Feel free to buy me a coffee. So far, many of you have been already doing it. I'm really proud on the 57 supporters. Most recently, Valdemar Sharmach bought me a coffee. Juraj bought me 5 coffees. Really thank you. I love Slovakia. I can tell you it's actually a really nice country. I've been there and I can recommend everyone going there. Mr. T, also thank you for the 5 coffees. Klaus, thank you for the 2 coffees. And Mr. Anonymous, Lauri from Finland, also thank you for buying me a coffee. All this money is not going down the drain. It's not just coffee that I'm really doing. You already made me achieve my goal of €500. That allows me really to visit my buddy, engineer my freedom. We're still agreeing on the dates, hopefully in the first week of January or something really quickly thereafter. We will be able to see each other for the first time in person, and of course we will record some Dividend Talk podcasts. But what you can see as well, all of this what I'm doing is not for free. That's why my next goal is to collect €800, because that's approximately the average cost I have to keep the blog and the YouTube channel and Dividend Talk alive, because for instance hosting €150, MailerLite subscription, it's a mailing list, €360 on an annual basis, WordPress plugins €150 and some other stuff. So to quickly sum it up, thank you everyone, and if you are enjoying this video and you would love to sponsor me or to support me, this is how you can do it. Find the link in the description of this video below. Let's move on again. Still stay with me, because the second stock that you request a lot about was Abbvie. Abbvie is one of those difficult stocks to analyze, right? At least if you're not really familiar with it. Abbvie is a pharmaceutical company and actually a spin-off of Abbott, which has continued to live onwards as Abbott Laboratories. It's a biopharmaceutical company, a typical biotech company, and their main drugs is really Humira. That's why they were spun off as well, so that they could live on their own, but of course with a huge patent cliff coming up. So what the company did already, it purchased Allergan back in 2020 for a total 63 billion in value. Now, this is a lot, but with that, it really diversified its portfolio because it got the brand Botox as an example. And, which woman doesn't like Botox? And actually, which guy doesn't like a woman with Botox? But also, they took over the neuro portfolio. And for instance, they have now a drug also targeting migraine. Now, we know how many people are suffering from migraines. So I think this is really at least de-risking the overall portfolio. But still, Humira is really, really a big one, right? And what is important here that we also see their strategy around this. And what, based on this 2020 strategy document, what Abbvie is really trying to do is it is using Rinvoq and Skyrizi as two new drugs to really replace the Humira patent cliff sales decline because of biosimilars. And they're actually quite successful in this because what we can see already year over year, if we look at Skyrizi and Rinvoq, they have been growing 75% and 53% in their portfolio. They are really driving it. It's also becoming meaningful now because Humira is still bringing in 5 billion just in the US and 5.5 billion internationally. If we look at Skyrizi, it's already at 1.4 billion and then Rinvoq at 700 million. This is to get a 2.1 billion, while it was almost nothing just a few years ago. So they're really doing a good job. And if you want to stay really up to date on how they are doing, please follow Dividend Wave on Twitter. I will put his Twitter handle and the link in the description of this video below because he's every quarter when Abbvie is announcing their results, every quarter he's giving us an update on how this is doing. And what you can see here is that their growth quarter over quarter is really stellar. In 2019 there was nothing yet, and now they're making here 1.4 billion and 700 million. So for me, this is a huge success, and it has a lot of potential really to prevent this patent cliff. Now, but with this, after the Allergan acquisition, what's also really important is that their debt is really large. They currently have a long-term debt of 60.4 billion. Actually, after the Allergan acquisition, it went all the way up to 78 billion. What we can see here in 2020, while initially already it went up in 2019, but a lot of cash was also used to finance this deal. But what is then important is that we see evidence that this company is paying down in steps. So what it has done, it has brought down from a 77 billion net debt to 58 billion right now. This is really, really stellar. And this doesn't go unnoticed because also Moody's has upgraded recently on the 17th of November after their quarterly 3 earnings, the credit rating of Abbvie. And what they mention here is that the upgrade results from strong operating performance and ongoing debt reduction that will mitigate the impact of approaching Humira biosimilar competition, previously a significant constraint to Abbvie's credit profile. And if you then look at, and that's why I always like these reports a lot, factors that could lead to an upgrade or downgrade of the ratings, again, is like how they are managing their debt. It's all about the debt and what their pipeline is currently doing. So I just showed you these two factors and they both are really in a positive trend. Also, the good thing is with a company like Abbvie, they are anti-cyclical when it comes to, for instance, a consumer recession. When people are suffering from, for instance, let's say Crohn's disease or cancer, you will continue seeing a doctor, right? So this is really in its favor of Abbvie. If we will have a severe recession, I don't expect a lot of impact to their sales growth. Having said that, now that we know a little bit about the business background of this company, not a deep dive, just a quick take, let's go into the dividend safety of this stock. So in my opinion, the dividend is also safe here. Look at the free cash flow growth and the EPS growth. This will be, of course, a bit impacted due to the Humira sales decline. There will be a little blip there before they climb the next mountain of earnings again. Credit rating, currently Baa1. Debt to equity is on the high end, but it is declining, but they can easily also coverage the interest. Of course, interest rates are rising, so maybe this becomes 5 or 6 in the near future. Still, they will be able to balance it. Cash flow payout, 47%, 51%. The thing is, if they increase their dividends really rapidly, what we will notice then is that there is less to pay down the debt. So I believe that generally their dividend growth will be a bit limited to what compared to what we have seen in the last 5 years, because then they were growing their dividends with a 21% compounded annual growth rate. During the last recession in COVID, they increased their dividend and they have strong growth prospects, in my opinion, when we look at the new pipeline. So dividend is safe, in my opinion. Everything above 60 is a safe rating. 80 is very safe. So it has still a bit of way to go to enter that section where Microsoft and Apple are. But you know, for what we are talking about here, I think this is a really good score from Abbvie. And we can also here see in the trends that the only way was up so far. I don't believe that this will continue over the next 2-3 years. We will see a brief decline, maybe towards 10 EPS per year. Still, we are talking then at the current share price of 16 PE. Free cash flow numbers, dividends are going slightly up. Not a lot of repurchases. We also don't need that. Shares outstanding went a bit up after the acquisition because some of the deal was also financed by issuing stocks. But other than that, it looks as what to be expected and the trend is into the right direction. That's what we want to see for this company. So what's else here to say? 9 years of dividend growth, currently a dividend yield of 3.6%. This makes it still one of the better yielding stocks for these kinds of dividend safe quality stocks in the dividend aristocrat lists. The dividend growth has been nicely, as you can see, currently paying $5.92 in dividends on a forward basis. What's important to know, I bought already a lot of this stock when it was trading between $60 and $70. So as you can see, this has been one of my best performing stocks, one of my best performing buys. And I remember everyone thought that Abbvie was dead. They will go bankrupt with Humira. Although I felt like, you know, the stories around biosimilars and that they would overnight just wipe out all the sales on Humira, I don't believe it. They have a strong legal team. Secondly, biosimilars are really, really hard to produce. These are not generics. And if you understand that, then usually the media and the news are a bit overreacting to this. Nevertheless, let's do some calculation. So if we work with a free cash flow of 20 billion, which I think should be possible still for the next 2 years, let's say. But therefore, because it will have a little blip, also take low growth numbers like 5% and 3% thereafter at a discount rate of 12.5% for 14 terminal multiple. It is not like Home Depot, I think, on the same quality of earnings prospects going forward. At a 70% profitability, I believe that this company will be worth $149 today. That makes this stock a little bit overpriced at the moment at $164 since the latest run up, but not too far either, 10% let's say overvalued. If we're a bit more optimistic, 7% growth and 5% growth thereafter, this stock would now be undervalued by about 10% because then the fair value per share would, in my opinion, be $184. Now the question of course is like, do you want to calculate with this 20 billion or less? You can do less, you can do more. I believe it's an assumption here. So please take this into consideration. Don't follow my fair value estimate blindly, because the trick here is what kind of free cash flow are you assuming, and can you indeed assume these growth rate numbers? If you take a little bit less, then might be 125 or something like that. Guys, having said that, I really hope you enjoyed this video. These were two much requested stocks that you really wanted to hear my opinion on. I love them both from a business quality point of view. Thank you also for recommending Home Depot several times. I've never really looked into them because it never came through my stock screener. But honestly, if it ever dips to those places that I showed you in this video today, I would definitely consider it in my portfolio. Abbvie, I already have a full position in. I don't intend to add more. I just let the dividends compound and reallocate the incoming dividends from them into other growth opportunities, like for instance HP Inc. or Viatris, as I showed you earlier today. Guys, if you like this video, hit the subscribe button if you haven't done so yet. And of course, thumbs up always puts a smile on my face. And hey, if you want to see other stock analysis videos based on stocks you would like me to talk about, please also let me know the tickers in the description of this video. I will add them to the list and I might bring them up somewhere in the upcoming videos. Guys, have a great week ahead. See you again.